mailed it out to you all. He picked up the book off his desk and said, "This is a book that you guys are going to need. It's $200." So I immediately said, "Well, why don't we subsidize it?" So that's something we need to talk about. See if that can happen. One of the other courses coming up, and I don't remember. He just picked it up, but I probably should have taken another what course it was, but I didn't. Nice slick book. And he said for an upcoming course is $200.
Maybe it's the bonus. Hey, Doc, hey, I need about 5 minutes, okay? And then we'll, just govern your time.
All right, so, yeah, I guess we could do it too. I
Well, I told them that the best thing to do, they did talk about ordering books from bookstores. I don't know what the mechanism is, whether or not it's subsidized or whether or not it's got to be 100%. But you know what I'm saying?
305 962 6864.
Are you living by it?
305 962
You live next to me. I live in the Brooklyn.
That's all right. 305 962 6864.
I'm not going to believe you until I find it. It's like
No more questions.
Oh no. Yeah, I'll give them a call and see. And my company might provide the cost.
Oh yeah, I mean definitely. I'm sure that we can get we'll figure it out.
I remember that one.
it's a big
Thanks, buddy.
Hey, is anybody taking a laptop? Is anybody taking a...
No, it was, I don't know if 40 took it, but that's...
Oh yeah, or it's still laptop there, so like I gotta get all right.
Yeah, you know you're shit talking in before the game, and then be nowhere to be seen.
Right. Tallahassee, like a transfer for you, where it goes up. You need like a smaller lecture to like what it is.
He's hilarious. And then the other guy, he's in North Carolina.
Wednesdays we'll have to hang out like outside of.
Wait, so is Dave off?
Yeah, they're doing projects that they're doing more. They're doing multi-family, and they're doing this, and also Nashville. I think they have a special office now. It's only like 4 or 5 people.
But it's cool.
This is your question, right?
And you don't have to address all of that. And you might want to take a couple of
information for some of this topics, and then some I haven't even touched yet.
Jaguars like your crowd.
Right.
whatever you want to do. This is just like when I read the article, I don't
Really?
I think it. I would leave her like yes, you don't understand. You don't have to do but it can guide you.
I mean, it's still underused, so. I was showing him if you don't want to sell.
Yeah, I don't know.
For you.
I've been trying.
all over your
We lost it.
I do not understand. Don't tell someone.
No, it's not even that. It's not. Ryan's Comfort. I spun the wheel.
If they understand,
Almost want to dodge Dakota.
oh my!
But instead you got a lifetime or a month, a year long supply.
Yeah, that's right. Recognize.
You got how many? They sent you a giant box.
Manufacturer certificates.
Oh my god!
You just go to your local store.
Great, so much better.
I would have hot side parties.
I kind of really pulled up just like a box of hot boxes.
The thing is, they think that their lifetime supply is probably
Nobody's mouth can take that much hot molten lava.
You should be like, you go nuts until that year's up.
That's right.
I don't know. Your quarterback.
Oh my god. I have 5 guys on my team. Or 6 guys. My entire bench is 5.
Same here.
Oh, that always happens. I only think about it when I draft. Like, oh, you guys and then I think of a bunch of like scrubs. I have 2 tight ends. I get it. I would just pick up someone else. I can't. I gotta reach in all. You don't want to just give up one person on my go. No, because they're all my usual starters.
Yeah.
What's wrong with going?
You know what I'm saying?
So my problem is that nobody listens to that. I have no running backs.
You go shopping, you gotta check out the little sections on the side.
How many people are you looking at? Yeah, and you got all those?
Yeah, because everyone with our running backs heavy now.
I always
You're not in a book these days at all. Yeah, but they reception.
You're running back.
Receptions, man.
You guys have any draft days? Larry Fitz?
Yeah.
No, I didn't pick him up. Yeah, he was late in my round too because he did terrible last time.
Yeah, but I
So I didn't even talk to him. I was pretty late in my round too.
it's on waivers.
That game was done.
You know how you gonna make money? If you could come up with like Pandora for books and make it sexy. Do it for textbooks, do it for like stuff, do it for magazines. Do you be back? Because
Well, he just told me you don't need to run the form.
Yeah, you're gonna read it and they go through 2 pages of form and you're like, oh.
Yeah.
Oh, the truck. Yeah, that's the account.
I always forget about Thursday.
Always screwed me
you guys complain about it and that boy gonna get elected. Look at the polls.
Sucks.
The white guy goes up like, oh, what do you think about
Terrible.
He had like one week where he did well, and the rest of them had the
I got someone big off of waivers just the week after he exploded. Awesome business. Yeah, I can't get running back, dude. One kid has 4 running backs, 4 starting running backs. One of them is that military. Like, I'm not going to trade for 4 years. I'm like, dude, I need now.
We screwed. How you gonna run 2020?
Bring on
I picked up the backup. Luckily, I got a little waiver.
I don't want to get the waivers, but
You gotta relax. Try to go build us up.
Everyone wants to grow on.
how do they choose the order for the waivers?
It depends on how my reviews are. Well, it depends, like.
Or you can choose on how you show, how you.
It depends on how you set up in mind. Whenever you claim a waiver, you're set up
So every time you have to pull a waiver, you're going back on top, no matter what.
You're at the bottom.
Yeah, I mean, you go to the line.
So that's a waiver. But that's like a different. Once a person clears waivers, then the free day is the count.
Yeah, I know that, but what if somebody never uses their waiver? You're just gonna sit?
Yeah, you sit.
I don't talk politics
But
about
for instance, on the waivers from anyone, you take up that waiver.
Did you go to the ULI event? Did you hear what they were
But
talking
I'm
about?
playing them this weekend.
Are you still like MSRED?
They like.
Or not next week, the week after.
It's like right now.
The 14th. Oh, yeah.
Yeah. So when you move your money up from one place to another place, guess what's happening to the gap?
Well, we have inversion. What's messing up? Everybody wants to move their money. Oh, actually, emergency applications for the first thing.
Yeah.
Smaller businesses.
Overseas, for tax purposes, tax purposes.
Yeah.
Yeah. But still, a certain amount of capital is coming here for investment purposes. China is having a problem with controlling their black market and capital. Yeah, so other countries in Latin America, they're putting their capital. You know, the economy capital coming in and the rates coming in. There's some good points. What's happening is the overseas jobs that left here to go to India and China, especially India, they're the ones calling them really good quality jobs. So anything on the outside, I'm saying no. There is that jobs and manufacturing is going down the next the cost of transportation. Right. So that's why Mexico is not an issue. The rate of Mexicans that are there's a trend that are rounding up that's under the radar that are and it's clear that what do you remember? They need immigration to sustain That's right. And then of course, and not only that, this is what China is doing to take care of those students. They need it. Yeah, but they need it because it's mutual benefit. This middle class society, that's the education
I don't know.
No, everyone gets, but they're like, there's videos like, back in the day, it was like, she thought it was real. No, I haven't. Maybe I didn't watch the he retired now.
I think you've got so much material that you can I'm telling you. Oh yeah, they showed it in the box. So trusting of because then maybe
they would film people watching.
I would guess though.
But wait, I apologize, I have to return a couple of calls.
That mean we're staying late? Yeah, it was inevitable. It was inevitable. It wasn't.
Tyler, don't you know the answer to that question?
How's your soccer team doing?
I don't need to because I enjoy this football.
No, football's done. We the week after I was here, we wrapped up. We played a not so good team. We finished 5-5.
You talking about football or soccer?
Football, like American football. We wrapped up 5-5. But the one interesting thing, sorry, ladies. In the last game, we had a boy. We were pretty banged up. We lost 3 running backs throughout the year. And yeah, stupid things. You know, one like fielding a punt in practice broke his finger. Another one had a fractured leg. The other one had a partially torn MCL, not ACL, MCL. But so we were really down to one like real running back and like a couple guys we brought up from JV. So we kind of modified what we were doing, and we really focused this one kid. And he rushed for 315 yards in the last game. And you realize like the next day, he was sore. You know, that's how you know they want. Of course, coach. And you realize how hard it is to run for 100, how hard it is to run for 200.
Oh, yeah.
But when you even see a kid run for 300 yards, you know, it's like. So and he actually had like an 80-yard run that was called back. First,
So it could have been 400.
Well, no, we would have pulled. You know, we let some JV guys play. So. No, and so then we started soccer that same week, and we had a preseason tournament, and we played a school called American High School up in Miami Lakes, Hialeah, and they're pretty good. They're defending district champ in the big class, and we lost 3-2 on an own goal at the last minute. We played our second string that game, and then we played Columbus, which is a defending GMAC champ and state champ 2 years ago, and we beat them 4-2. And then we played North Broward Prep the other day, way north of here. We beat them 2-0. And we had something I've never seen before. One of their players hit our head coach after the game.
What?
Whoa. And then I got in the middle of it, you know, and he starts going, the guy starts going. The officials didn't see it because they were assessing the game. They had like other officials assessing the officials, so they were all in midfield. And so I got in the middle of it, whatever. The trainer came, we broke it up, and the kid was like going, "I hit you, what are you gonna do about it? Oh. Hit me, you'll go to jail." I mean, like, you know, the taunting. I had a friend of mine showed me once, his daughter had something she pulled down from the internet on how to get adults arrested, you know, and it's kids are vicious on it. Anyway, so we beat them 2-0, and then we went up to Delray to play American Heritage Delray, which is a strong program, and we tied them 1-1. And then we played a school called Miami Country Day yesterday. We played our second string, and we won 3-1.
What school?
Yesterday?
No,
What's your school?
It's called LaSalle. And so we're 2-0-1, and it's looking good. We got nice players, and it's really a young team. So.
Like you have a tie? Is that what we want is? 2-0-1?
Yeah, a tie against this American Heritage Delray. They've won like 6 or 7 state titles over the last 10 years.
So evidently you got your quarterback straight. You went through 5 interceptions.
Yeah, that was. Yeah, well, this is soccer now. Yeah, our quarterback. He didn't have a great game, but he didn't throw any interceptions the last game. He'll be there. He'll be fine. He'll be fine. He'll be fine.
Does the have a lacrosse team?
Yeah, unfortunately, yeah, but it's not very good. Do you play lacrosse?
Yeah.
Okay. Unfortunately, it's not. That's not a big. I went to school up north, and I remember going to see like Johns Hopkins play North Carolina in 1982. You know, so I've seen lacrosse at a high level. In South Florida, lacrosse is for a lot of kids who can't play any other sport. and at our school, it's like, no, it really is.
No, up north it's big.
Yeah, it's starting to grow though.
And there are actually some of the schools here, Pinecrest, St. Andrews, Gulliver, Ransom.
All
That's a very.
All the prep schools up north.
You have some pretty competitive programs. Some of the other, anyway. Enough of that.
I was there before you.
I tried to give you some. I gave you some information the other day that came out of Nate Creek. Today I'm giving you some information out of a firm called RCA, Real Capital Analytics. So there's 2 or 3 sources of information in the real estate arena. RCA is one of them. REE is another one. And they're all good. They all serve different purposes. Real Capital Analytics tracks sales data. They track sales data different than other firms. So their criteria is they pick up properties over $2.5 million. Okay, so they might have different results than firms that only track, you know, institutional grade assets or Class A assets. So when you look at RCA data, it may be a little bit different than what some of the other research houses are going to produce, but it's pretty indicative and very comprehensive of the market. And so what I wanted to do was give you a view of two different things. How we value assets. When Irene was presenting this morning, she was talking about discounted cash flows, and ultimately discounted cash flows, you know, talk to a return, right? Most of the times we talk about, you know, cost per square foot or cost per door, depending on the asset class we're talking about. So I want to go through the major asset classes and just give you a sense of where values are today, what some of the major subclasses or subclassifications or categories are within different asset classes. So for multifamily, we're going to talk per unit or per door. First couple of things that I would distinguish, you generally have two significant subclasses. So you've got garden style and you've got mid-rise. And what's garden style? It's what you see in Florida all the time, right? You know, 1 level, 2 level, right? You know, surface parking, suburban setting, right? And mid-rise is what? What may be in a more core, an urban core, right? So it might actually be, quote, high-rise, but it's, you know, a more dense environment, right? And so, you know, logically, one would imagine that mid-rise, just because of the cost and the rents that a downtown or a more urban setting are going to command are going to trade at a higher value. So, first thing that you see on the timeline. So, RCA starts gathering data in 2001. So I've got, what, 13 years worth of data. This is through December 31. I have to update this once a year. Okay, so they put their data out monthly, but it's pretty time-consuming to, you know, gather all this and graph it. So, first thing obviously is you see the significant decreases of, you know, plummeted values in the 2008-2009 timeframe. And the reality is, you can see the real estate to some extent lags the market. So while the stock markets were crashing in 2008, real estate sees the actual decline in 2009. Kind of interesting, right? Now, the next thing that you can see is that values are well above, in certain one of the subclasses, values are well above the peaks that we had in 2008 already. So when we mention things like real estate, you know, being at historic highs, it really is on definitely absolute values, and we'll take a look at cap rates in certain asset classes. It's definitely getting there. So, so mid-rise product nationally trades about $230,000 a door. Garden style trades nationally about $90,000 a door, right? So, you know, sort of implications you can probably figure out. These are probably $2,500, $3,000 a month rents. These are probably $800, $900, $1,000 a month rents for 2-bedroom apartments. Okay.
Do you need a prescription or subscription
to get this stuff?
Yeah.
I beg, since I'm an instructor, and so what they do is they give me a limited window to pull certain data down. Yeah, it's a very expensive service. So I write out my NOVA thing. I used to have, at one point they used to give me very broad access and it was open, and they shut it now. So I have to write, I have to send them what I produce. I send them a copy of these presentations, and I have to, it's only for, you know, academic use. So, you know, if a friend calls me and asks me for something, I can't use it, and I try not to. I try to stay true to it. So they do have some, if you go to the RCA site, rca.com, there are some reports that are available. They're going to be more generic, you know, in nature, but there are some reports that they offer for free. Now, I heard we were going to get some REE data at some point, or access to REEs, but then I heard in one class they burned it all or something. Is that what happened? Is that what you guys did?
We heard that.
Was that you?
That was you. He didn't tell us. He didn't tell us that we weren't allowed to use it.
Well, the guy was presenting, and we realized doing it as he was presenting, and it was like rocking out.
Do you see why I don't let people open computers? You know, it's like, Anyway, but so you can see the broad difference. Now Florida, kind of curiously, is trading almost at the same level as garden style, which would imply that Florida's multifamily asset pool is what? Primarily garden style, right? And you think there's not a lot. So cities that would have a lot of mid-rise product would be places like New York and Chicago and San Francisco and Boston, right? And you know, Florida is definitely a garden style environment. They started tracking, they didn't used to have this data, and they've actually gone back and accumulated it. They're actually tracking student housing. And student housing is a little bit kind of like hotels in that it's an asset class that is not just real estate, because you know, you provide internet and you know, cleaning and food in a lot of these places, and sometimes you rent by the bed, and you know, so it really is a totally different, but it's definitely a growing business. As universities have gotten away from the business of providing the residences, it's become a business for third parties, for real estate developers to fill into. So
2002, what's happening there?
with student housing here, I can't think. It could be an error, and we'll talk later on. I mean, I can tell you they started accumulating this data sometime around here, and then they went back in time. So it's possible that there's just, you know, one of the things that I didn't talk about when we talk about appraisals is there's something that's also important anytime we analyze data, and that has to do with the breadth and the depth of a market. So if there are not a lot of transactions, it may not give us indicative results, okay? And so if the market is not deep, there's not, you're visiting, right?
Correct.
You just join in.
About that.
Absolutely. Your name is?
Jordan.
This is Jordan, everybody. Welcome, Jordan.
All right, Jordan.
Thank you.
All right, you have to stay as long as you'd like. But the test is at 4. So make sure that. But it could very well be that there are only 1 or 2 transactions.
Yeah.
Okay, so yes, no.
Based on what you were saying with the, I guess, graph kind of lagging, do you think it could have been because of the World Trade Center in 2001? And then
Well,
that was the concern? And then
Well, but notice that the one that only drags is student housing. All the other ones don't have that problem. And so 2001 was not so much an issue of September 11th, I think, is, in fact, there was a bubble that sort of, a NASDAQ bubble that sort of hit us in 2000, 2001. And so there were definite economic currents that were hitting us in this sort of time frame here, regardless.
I think that's just a lack of data.
It could be. It could be. And that's, you know, what I would say. So I look at the same asset class now, and it's sort of the relative valuation. We talk about cap rates, right? Because we can compare values per door, but every building is unique. And so, you know, well, that one's $230,000. Well, you know, so what are people paying for the yield of cash that they're getting? And as I said, I'm going to keep repeating, the real estate asset is worth nothing more, nothing less than the net present value. It's future cash flow. That's, people buy real estate for the income that it produces, not for anything else, okay? There may be some other offshoots, but that's really, so I graphed the trend. As you can see, the general trend is downward, obviously, and they continue to come down as time goes on. Where you see blips, sometimes they have not finished. I did this in April. They may not have finished accumulating their cap rate data. Now, understand, cap rate data is speculative. Sales prices are fixed, but net income on properties are not publicly known. So they try to triangulate to those numbers from whatever information they can get. Sometimes buyers and sellers share it with them. Sometimes they don't. So it's a process that takes them a while, and so that's why this one ends a little bit early. But general trends, down. You see in 2009, cap rates go back up, and cap rates now are again below where they were at peak times. Okay, so not only have cost per units gone up, but the relative valuation has also gone up. Yes?
What's like the strongest factor to drive cap rates down? Like, is
You
there
want to do a
one
paper
thing?
on that one?
Huh?
You want to do a paper on that one?
I mean, like, is there one thing?
He's there.
Look what you've done, avoid the question. Look what you've done.
Well, if they think about that, I'll get back to you.
You know, I found that I had this presentation from a former student, and one of the things I had him do, I challenged them on, and this particular one was leverage. So whoever's doing leverage, don't copy it, okay?
You go slower?
Yeah, hold on. I was gonna get that's you, right? So some of the things he started doing was actually taking a look at what impacts IRR, right? And you know, does hold period impact it more? Does interest rate? Does LTV? So you can, you know, does NOI? So you can take a look at any series of variables and do data tables, right? And figure out where the optimal points are, right? I think this particular one is where, you know, where negative leverage kills you, right? So here he was just trying to talk to, you know, there's positives to high leverage and there's negatives to high leverage. But what I wanted to illustrate was, you know, what's more significant. You can sit down and play with sales values, right, and NOI, and draw your own conclusions. Okay, I don't know if that makes any sense or not. What I did. So.
Send that to me.
Yeah, it's in the mail. Okay, so the other indicative thing that I try to do is I put the 10-year treasuries, because ultimately what we've said is, and we'll show in class later today, if we can get today 2.33 return on a 10-year treasury that has no risk, right, then what should we be willing to pay for something that has risk? And so there is a historical trend between different asset classes and treasuries, right? And so what I can tell you is when you look at this compression, right, when you take a look at the fact that there is only a 100 basis point spread essentially between what risk-free treasuries are and what returns on multifamily assets are, somebody should be telling themselves there's a problem here, because you know, owning any kind of asset that has risk should give me some, you know, greater reward than that, right? So, you know, treasuries have continued to come down, and so we've got a healthier, you know, I think some people can argue that we may be in a healthier position today because there's a healthy spread between what the risk-free environment is and what people are willing to pay for the asset. So even though people are paying more than they used to pay, the alternative investments are that much lower. And so there is breathing room to say, hey, it is a risk worth assuming. Make sense? Industrial. Industrial has two major sort of, so there's warehouse and there's flex. Now, in Maricela's presentation, she classified flex as office space. So what are the different, what's the distinction between a warehouse, you know, an industrial asset and flex space? Anybody want to venture?
You can convert the box, like industrial box, into different uses, or?
Well, let's talk about characteristics of, let's try somebody, let's talk about characteristics of the box, because it could be the same box.
It has different features on it. I think we went to a flex space in this class where, you know, the outside was open to an office, and then it went back into a giant warehouse in the back. So it was basically, it served two purposes.
Yeah. So
you could have AC depending on part of your house.
The single biggest determinant is the significant office component of the industrial space. So it could be the same box. It doesn't have to be. They're built differently, but it could be the same box. It is flex if, for example, 50% of that space has been built out for office. Okay. So where do you see flex space? You see it a lot with smaller businesses, so they can have their offices and their showroom up front, and their storage in the back, for example. Okay. Now, historically in this country, flex space also has different characteristics. It tends to not have the same height. It can be at grade because, again, they're not high volume businesses, so you don't need to have the truck court, you don't need to recess to have the door in the back. It could be front loaded. So there's a lot of different sort of features that it has. Flex space tends to command a higher rent, and because it commands a higher rent, it obviously sells for it, because it has a higher office component, sells for a higher cost. So you're looking at about $115 nationally. Warehouses are at $55. On a blended basis, you're at 70, right? And Florida is at 90, right? So my question to you, or 85. My question to you is, in South Florida in particular, Dade, Broward County, forget Palm Beach for a second, where would industrial product be trading?
West. Oh.
By the airport.
West.
No, no, at what dollar value?
55. High.
55.
Much
So our number 2, yeah. So, you know, probably 120, 130, which, you know, gets back to, I read the other day that some industrial deals are being done in western Dade County now at, you know, $12, $13 industrial gross, which, you know, is like well over where they were in 2008, you know, before everything blew up. So they're starting to get to a point where you can justify development. Because again, do the math, right? If it's industrial gross and it's $13, right? And let's say that operating expenses are $3, that leaves you at 10, divide 10 by 120, and that gives you, what, 7, 8% return? And it's probably trading at higher than that, because cap rates are, in a city like Miami, are probably closer to 5, and I'll show you that in a second. Okay?
Sir.
Yes, ma'am.
Maybe I missed something. You said the flex space is trading at 150.
115
Right, and you just said the industrial would trade at about 110.
in Dade County.
That is go across at like 85.
Yeah. Yeah, but I said this is all of Florida.
All Florida.
It's all of Florida, and remember, these are transactions that are over $2.5 million $2.5 million. So it's little transactions and big transactions. So if you look at big industrial space, and the reality is with land trading in these 2 counties at $20, $25, $30 a square foot, you cannot build for probably less than $130, $140 a square foot. Okay? Make sense? These are frames of reference. You know, we're in a room and somebody says to us, hey, you know, this building's trading at $95 a square foot. And the question is that good? Is that bad? You know, how's it fit in? Cap rates. So the cap rates have the same general trend down. Cap rates for all asset classes have the same sort of trend. They all tend to be, you know, very close to one another, right? Irrespective of the fact that they may trade for a different dollar value per square foot, but on a relative valuation basis, very similar to one another, right? And on a national level, you're seeing close to 7%. In major port cities, industrial cap rates are closer to 5%. So Miami, Broward, you're going to see cap rates significantly lower than this. Again, not as tight as multifamily, but definitely a compression here. And now you see a widening where, again, you know, for whatever the reason, people are paying astronomical dollars, but they're feeling comfortable about it because, you know, the spread over a risk-free investment seems to be, you know, worthwhile, right? So you're talking about 300 and some odd basis points. You know, that's not bad. Okay? Questions, thoughts, comments, observations? Office. So, medical is new for them as well. They historically tracked only CBD and suburban. So different attributes of CBD, they tend to be in urban cores, right? Credit tenancy, long-term lease rates, long-term leases, higher operating expenses, higher services. Suburban, smaller tenants, shorter lease terms, less credit, lower operating expenses and less services. Okay, rents are probably in the suburban area in South Florida in the 20s. In the urban, they're in the 40s and up, 50s and up. Okay, now operating expenses, you know, are different, but you start getting a different sense. So CBD, as you can see, is right back up to where it was, about $350 a square foot. National average, you know, a Class A building in downtown Fort Lauderdale could easily trade well north of $400 a square foot. In fact, will easily trade well north of $400 a square foot. Okay. When you take a look at suburban, totally different environment. $160, $170 a square foot. Okay, Florida, primarily a suburban market. We don't really have, you know, the CBD in Miami is very small, 20 some odd million square feet. The CBD in Broward is very small, like 5 million square feet, something like that. Is there a CBD in Palm Beach County? I guess there is, but there's like 2 or 3 buildings. Jacksonville's not even in this state. No, I'm just kidding. I'm just kidding. No, there's a CBD in Jacksonville, but it's relatively small. And Tampa's CBD is relatively small, as is Orlando's. So just not a big. Florida is primarily, just by definition, if we're a garden style, you know, multifamily area, because that's where most people live, we're going to be a suburban office market as well.
Will we get the spot point, by the way?
I'm sorry?
Will you provide us with a spot point?
I don't usually provide my material. I'm going to publish it maybe one day, I don't know. But you can take notes on it. I'd have to like have somebody edit it and all that. But I mean, I'm pretty sure it's like a fair bit of time. Sorry. I need to make some, listen, it's not worth writing a book. If I wrote a book, somebody would buy it. I don't, you know. So, cap rates, again, spike up and then back down almost. Office is a risky asset class. One of the other things that I challenged Marty said on the Office article was to address potentially some of, Office has certain risks that other asset classes don't have. And that is that Office has significant capital expenditure outlays in its ownership. Because every time a new tenant moves in, there's significant, or there's expectations to redo the space. And so, you know, every time somebody's coming in, you're putting $30, $40, $50 a square foot into refurbishment, right? And you're paying huge commissions up front. A lot of times picking up, leases, people are consolidating, you're picking up leases in other places. So, in Office, you kind of tend to have a significant component of your return tends to be backloaded the day you sell a building. So, it's not, as you can tell, multifamily and industrial have come back down even below where they were in 2008. Office is still not quite there. It's still a little bit higher, okay? CBDs, just because of their credit profile, obviously have come down. The other suburban have not. Again, tight spread, widening again. Retail. So retail has a lot of subclasses. RCA doesn't track all of them. They basically group them into mall and other and strip. And strip they use like grocery anchored. So kind of like big and small. And $300 a square foot mall, big destination centers, big services, right? Simon, that kind of stuff. And strip, anything from a 3,000 square foot corner with a Subway and whatever. No, well that would be a little bit like a AT&T or whatever, and a dry cleaner, and the nail lady and all that kind of stuff. So, and you can tell, Florida, curiously, is somewhere in between, right? And I would have thought Florida was much more of a strip center, but what is Florida? The ones who did the accounting class, Simon's largest market is, well, it's not just state land, Florida, California, and Texas. So, well, they've got the outlets because of all the international tourism that comes, so they've got a huge exposure there. But it's also the large destination, malls as well. So Florida, you'd think would be more of this sort of outdoor, suburban setting, but the Sun Belt states, people shop in large covered malls. Even though the weather would let them go outside, but they go for the air conditioning, I guess.
They think the sales for square feet moving.
I don't think anymore, but for many years, Dadeland was the highest grossing mall per square foot in the country. And it is not any longer, but it's definitely one of Simon's better performing properties. And if it weren't, they wouldn't keep investing, continually in it. And so how does that translate to cap rates? Again, so you see the down, back up, down, and you know, the same tendencies we've seen, compression and widening of the spread. Now,
For
yes, ma'am.
That data, how accurate? Because you're talking about the.
How accurate is it? I'm giving it to you. It's not accurate at all. No,
No, I'm just asking because it seems that the bigger malls would be owned by publicly traded companies and the strip malls by family, small.
well, okay, so as it relates to dollars per square foot, you've got to believe that a firm like RCA is going to do their best to identify what transaction values are. And in this country, sales of real estate, real property, are recorded publicly. And thus, unless there are agreements that you generally don't see that are not recorded, you typically can see what the sales price of a property is. So the component that relates to value and cap rate, you can definitely see. What you don't have access to is net operating income. And so, how accurate is it? Listen, it's indicative, okay? It's representative. I would tell you that when you take a look at my personal experience, typically relates with Class A and Class B plus type assets of institutional nature. And so there would be larger transactions, and they would be in larger markets. And as a result, my personal experience, for example, why can I tell you that cap rates on industrial in Dade County are closer to 5%? Because I've lived those firsthand. Now, if you believe RCA, it's closer to 7, right? But they're taking a look at a much broader pool of assets, and as a result, they're going to have a different result, right? So, is it accurate? I think it's indicative. And if you use the same methodology over a period of time, you can start drawing some conclusions. I'm going to come up on a slide in a couple, which is not in any way meant to be 100% indicative, but I think it's representative. And so it helps us, it's part of the inputs that we use to derive answers, okay? So, I just overlay, it looks like a mess, but you can kind of see the, you can see the trends, right? You can definitely see CBD office seems to be like the most dear of all of the asset classes, right? Sorry, CBD, mid-rise multifamily, CBD, and upscale, okay? So, this is just overall, so I averaged all the cap rates so you don't have to look at a bunch of different slides. Just, again, you see 100 some odd basis point spread, 300 basis point spread. Okay, you see natural evolution. Now if you graduate and you're in the business 5 years from now, treasuries are 4.5%, what should your expectation out of the box for cap rates be, right? Add 300 basis points to it, 7.5%. So now, every market's going to be different, every asset class is going to be different, every asset's going to be different. But now you've got a historical frame of reference of 3 to 400 basis point spread as being something, in equilibrium that you should expect. So, inverse PE ratio for the S&P 500, right? So the PE ratio is price over earnings, right? Cap rate is what?
NOI over value.
Earnings over price, right? I mean, not exactly. So let's try to look at how real estate is valued versus how public equities are valued, at least during this time frame. And also contrast that with where risk-frees are, right? And so here you see historically that the inverse PE ratio has a lower, essentially, cap rate, right, than what real estate has. Make sense? So public equities during this time frame compared to the observations made by RCA, would imply that while real estate may be a good asset during this time frame, equities are still valued at a higher multiple. Yes, no, maybe?
Let me see again, sir, please.
The implication of this chart would be that during this time frame, publicly traded equities, right, are trading at a lower cap rate, i.e. the investor base values them at a higher multiple, at a higher PE ratio. Now, this is a very important one. This is a very, very important one. So this is absolute volume of commercial real estate transactions based on RCA from 2001 onward. At their peak in 2007, we hit $450 billion worth of transactions. That dropped to $50 billion in 2009. What do you think happened with appraisals in 2009? How could you appraise something? Who could loan on something when there's no comps out there? I mean, we look at this. I mean, this is like, what's that, El Capitan or whatever in Yosemite? You know, it's like straight down, right? I mean, it just like died. The volume's almost recovered to historically high levels. Okay, and you can see where we started just 15 years ago, $100 billion a year. We're trading $400 billion a year of commercial real estate assets every year. So, you know, going back to the arguments that I'm talking about, this isn't something to put your name on. It's not about the color. It's about cash flow. It's about an asset that's traded in the capital markets. I think this demonstrates it.
National.
Yeah, so this is total transactions, okay? So you can see this is in billions. 462 down to 63, and we got 370 billion.
Do you have it by asset class?
I'm sorry?
Do you have it by asset class? I don't want to do it. I'm just asking.
So are you saying another
Yeah,
peak?
probably.
Are you saying that another peak is coming soon?
Not necessarily. Not necessarily, Tula. I mean, here's the where I would speak from prudence would be whenever you start seeing historic levels one way or another, they might be times to make contrary decisions. Okay, so if values per square foot and cap rate are on historical highs and cap rates are at historical lows, and interest rates have been at historical lows, but there's a tendency or an indication that they may be moving up, and volume is almost at historical highs. You know, so now I'm putting together 4 or 5 different. I don't know how to time this, but you're probably getting closer to a point of inflection where, you know, I think I made the comment the other day. A friend of mine owns or owned self-storage facilities, and he bought. I mean, he was at one point he was a publisher of the Miami Herald and all that. But he had his work, and he bought one, and then he bought another one, and then when he retired, he bought a third one, and he's been living off of this for the last 7-8 years. And 2 years ago, he sold the store he had in Miami. Last year, he sold the one he had in Leesburg, and about 3 weeks ago, he sold the one he had in Orlando. And his comment to me, because I got on a call with him and another friend of mine the other day, his comment was, "I'm not out of the self-storage business. I'm just getting out temporarily while people are willing to pay me a lot more than what it's worth. And in 2 or 3 years, I'm going to come back in." And when you take a look at development cycles, so I put him together with another friend of mine who wants to do this. You know, he said, "Look, I can start looking at it now because I'm looking at a 3-year, you know, by the time you permit, design, and build, and deliver, and lease up, that's 3 years from now. So I may be ripe to start a development project now." He goes, "But somehow between now and then, I think some of the appetite for that particular asset class is going to go away." So am I predicting doom and gloom? No. But, you know, and can it not keep going up? Yes, of course it can keep going up. But it probably has more to drop. You know, values have probably more to drop than then they have room to go up.
There's a blip.
You know, I've been saying that for some time, and I could be wrong. I mean, I looked, I didn't get my journal before I left the house this morning, but I mean, I think the last time I looked, public equities, the S&P 500 is trading at almost 23 times trailing earnings. You know, that's huge. That's huge from historic. So, you know, and the problem all comes back to this. The problem all comes back to treasuries at, you know, 2%. People need money, so people are pouring their assets into assets that could give them yield over and above what these investments are going to give them. And the minute that this moves up, it's going to change the whole distribution of, you know, the whole allocation of investments. As I see it anyway, you know, it could be wrong. Now, so this is the slide that I said. So this is actually not, so what I tried to get is just taking the historical data for the 13, 14 years that I have. I wanted to get an idea of two things. One, how much of the state was each of the major metros? So how important was each metro? And the other one is how big were the asset classes? Now, this is 15 years worth of sales data. It's not assets in place, but over 15 years you get so much information that you start thinking, hey, this might give me a good sense or idea of the way things are dispersed, right? And so this is just the sort of grid that supports what's here. But if you want to take a look at markets, you know, by far, Miami-Dade County is the biggest or the most important, one of the real estate metros in Florida. And then we've got a close tie right here between Broward, Orlando, and Tampa. And then you've got West Palm and Jacksonville trailing a bunch. Okay? And when we take a look at assets, office is second behind retail, but they're like neck and neck. Industrial, and then multifamily is the one that is the single biggest one. From the transactional, that's not to say that those are what's in place, but it starts giving you a sense of how you can distribute, or how assets are distributed by value in the state. May not be indicative, so it may not be absolutely true, but it may be representative or indicative. Okay? Important. Interesting information.
Did you create this? Okay, well, we want your slides. What do we do? Buy them?
No,
Is it for sale?
No, they're not for sale.
We got it on YouTube.
See, like for instance, the problem is distributing. So like I just looked at the slide and there's an error in it, right? So the first error is that it says 12-year and it's really like 14-year. So when I did the slide, it's like nobody's edited this stuff. The other one is there's no footnote down here that says what I just said about it being representative data. And I don't want people to take this information and misconstrue it. So I'm happy to share it with you. I'm happy to show it again. But I'm being serious. I don't want to put something out there that hasn't gone through a critical review process, you know, and people go, ooh, this guy's a moron, you know? I've had some like crazy professor with glasses in the back challenging me. Okay, you guys want to see more? No? No? You don't? You guys want to go to break room? Break? No, break!
What's that?
Okay, so.
Start chewing on some of those questions. I know we're very meaty, you know?
Meeky.
Meaty.
Oh,
Meaty
meaty.
is a lot, you know?
I told you I was gonna leave you with questions, more questions than answers in this class. So, now let's go through these presentations and then we'll go through the technical material. So, one of the other questions that I want to examine is does geography matter? Right? And if it does, how so? Right? So, oh yeah, does geography matter? Yeah, it does. Everybody says it does. But does it really? And how does it? So, I use NACREEF data for this one. So, again, you guys, so, you know, we talked about NACREEF and the number of assets they had and all that. And so, just to refresh, you know, roughly national returns, real estate, NACREEF, privately owned real estate, 9%, 7.5% standard deviation. We said when we contrast that to the stock market, it's pretty favorable, okay? At least in the privately owned arena. So the question is if we take a look at, if we decompose the NACREEF data and go by geography, are some geographies better from a risk-reward paradigm or perspective, okay? So we take a look at the West, and the West has a higher return profile than the mean or the national average, with a little bit more volatility. And okay, it's good to know. And the East even more so, greater return. Looks pretty good. And sorry. So we take a look at the South. Sorry. So we take a look at the South. Not such a great return, but less volatility, right? Those are like growing markets, right? That's kind of what we think about. And the Midwest, curiously, look at this. Very, very low volatility. So not great return, but very low volatility. And you know, my intuition would have been, you know, I think of Midwest, I think Detroit, Cleveland, Erie, Pennsylvania, you know, Peoria, Illinois, you know, I think like, you know, it's like industrial city. I'm sorry if there's anybody from Peoria here. No, but you know, if there's, you're not from Peoria, okay, just checking. No, but you know, I would thought, something down. But along that, curiously, there's a publicly traded REIT called REE, and it's based in Minneapolis, because see, the Midwest also has cities like Minneapolis and Lincoln, Nebraska, and they're very traditional markets. People don't move. People pay their bills. You know, very, you know, sort of, you know, deep-rooted American values. And so, hey, maybe not great returns. And remember what we talked about the other day when we asked what was a return? The next question should be, how much risk did we assume to get that return, right? So I'm using the so I just, you know, just, oh, I hold on. Hold on to that thought for a second. I overlaid the timelines over one another to see if there were, at least, you know, in a very simplistic fashion, some trends or ideas that I might be able to draw from it, you know. And so, for instance, curiously, it seems as the Midwest tends to lag everybody else, both in the drop and in recoveries. So they're not market leaders. They're after everybody else, right? And you kind of look, the East tends to lead, right? Both downward in the economy and kind of back up, right? Curiously, right? So, you know, when you play with data, that's why I like, and I challenge all you guys to graph things. Sometimes you pick up, you know, some trends that are a lot easier to look at this way than they would be just with, you know, sort of distinct standalone, you know, graphs or sets of data, right? So all of a sudden, you know, can I draw a parallel from this or project this to general economic trends? No, I can't, but maybe it poses an interesting theory to evaluate, right? And to say, if you're an investor of real estate in the Midwest and you see market values tanking in the East, what are you going to do? Start selling them, right? Start selling them. What you might want to do is overlay this versus maybe S&P 500 and see, how does the stock market move in relation to some of these geographic real estate markets that we can get our hands around and say, hey, if I see these trends in the market, do I buy, do I sell? Do I wait for the market to turn before I buy real estate? Or whatever, okay? So, again, I'm trying to give you tools. More than memorizing any of this, it's tools that you can take with you when you ultimately make your decisions in the marketplace. So, the thing that I try to teach you guys that the best way to, or one of the ways, not the best, but one of the ways to try to equate risk and return was always to reduce it to the coefficient of variation. How many units of risk did I assume for every unit of return? And when you take a look at that, you can see that investing in real estate in the Midwest was almost, half as, risky per unit of return than in the West. So you get all the glitz in the West, right? Movie stars, what was that? Beverly Hillbillies, right? You get all that, but you get a lot more risk associated with it. Okay, so, and then and definitely compared to the stock market as well. And then I plotted as well. This graph starts getting really busy because I left the original asset class analysis that I had, and then sort of overlay geographies with it, just to get a sense. So as we talked the other day, if we want to go northwest, right, in that return risk paradigm, right? Darn, if I own farmland in the Midwest, that probably is a good place to be, in Illinois, right, Emmanuel? Or Iowa, right? No, but you can start seeing that, maybe certain assets in certain geographies might actually make more sense, than hotels in the South might be a little bit more risky. Again, these are very general sort of propositions, but just to get you guys thinking, okay? Now,
you say it, Treasury doesn't have any risk associated with it?
A Treasury?
Yeah.
I hope it doesn't, because if it does, we got problems. Now, I say that, and I don't mean to say it in jest. I remember saying many years ago that I didn't care about the risk that I assumed, the sort of market or macroeconomic risk that I assumed by having deposits in a bank. Because my personal thinking was, B of A is not going to go bankrupt or whatever, right? But come 2007, that came very close to happening, right? And it came close to happening because almost, from a system-wide perspective, we really just had a collapse. So in the absence of a collapse, Emmanuel, in the absence of a collapse, a security issued by the U.S. government should be risk-free. I mean, in the worst of cases, you will get the face value of that currency back, or that instrument back. Inflation may make it worth little, but what does the government have the capacity to do? It can print money, or it can lay taxes on people. So it has abilities to repay that debt. It can reissue debt to repay your debt. Okay. In fact, what happens in a lot of restructurings is you don't get paid right away. You just get paid with new debt, usually worth less than what you owed in a particular time. You just get repaid with additional debt. Yes, Noah?
In terms of, since you touched on the T's, when you're swapping, what is the volume difference?
When you say volume,
since you're saying that essentially the Treasury can just release new paper, with the swaps and the volume of swaps versus the United States Treasury, what is the?
Look, I don't manage the data on the size of interest rate swaps versus the sort of U.S. Treasury debt market. I know the U.S. Treasury debt market in aggregate is, and this is federal government, not state or municipal, is what, $18.5 trillion. My sense is, and I know that the notional value of swaps go into the hundreds of trillions of dollars. So it's possible that the volume of swaps is significantly greater than what the absolute value of the Treasury is. But those aren't necessarily items that you need to link, because as long as you have counterparties, you can do swaps. We'll talk a little bit about swaps in a little bit, but so you've got treasuries here, right? But if I want to do interest rate swaps with you, I can do it, and I don't even necessarily need to hold this, instrument here, right? So, if the point of your question is there sufficient depth in the swap market?
I was thinking since you said worst case scenario, if the Treasury fell.
Oh no, but I don't mean swaps in the sense of swapping fixed for variable interest rate. I'm saying what happens in a lot of reorganizations is you know, you were owed X, you're given a new promissory note. You know, creditors are bundled, and I should say new debt is issued typically at a discount. In the U.S. government's case, what does the Fed do every time a T-bill or a note matures? They don't pay it. They have, they have auctions. They raise additional money. They pay this guy back with the proceeds that they got from another guy. And that's what I meant by swapping that debt. I didn't mean an interest rate swap, a fixed for variable rate. I thought that's what you were talking about. Okay, so geography. Now, I want to do a couple other quick ones, which while we're here, I think are unless you guys don't want to look at them. Are these things interesting to you or no? So, let me do this one first. Okay. So, I've talked about in this class the fact that I've given you some public market. I haven't given you really public market returns yet. I've given you private market data. But I'm going to contrast how the public markets react with the private markets. And the question that I would start is by asking is, should there be a difference, or is there a difference? The answer, but why is there a difference between the risk-return profile in public markets versus privately owned real estate? Well, so expand on that a little bit. You say regulation. The public markets have regulation. Private real estate transactions aren't really regulated per se, and private ownership of real estate isn't regulated per se. But because there's why is there regulation? Why is there regulation? But because there is a secondary market, right? Because people are trading, as we were talking about, investments between one another, and the government has decided that because things weren't being transparent, that there needed to be some public reporting, right? And so in a particular way, one can view a real estate transaction between two private individuals as a primary market transaction, right? The guy selling is receiving the proceeds, right? A public, REE holding is potentially, or not potentially, beyond the IPO stage or realm, is a secondary market transaction. And because it's a secondary market transaction, and because these are publicly traded shares, there is a level of liquidity that exists with publicly owned real estate that does not exist in the private realm, right? So when we looked at $400 billion worth of private real estate transactions in this country last year, I don't know the value of all the REIT transactions, but my sense would be it's many times that, okay? The volume, because people are continually going in and out of shares, okay? And so probably the single biggest reason that there is a difference in the profile is that publicly owned real estate has a liquidity that private real estate doesn't have. And in theory, there should be a cost associated with that, right? Now that cost may be in the way of a lower return, or it may come in the way of a higher risk profile, right? So let's find out if in fact that's true. Okay, so here I use both NCREIF data and I use NAREIT data. So if you go to NAREIT, what's NAREIT? Those who took the accounting class? Alexander, NAREIT? You didn't pass the first test, did you?
No, I didn't actually. Some test.
National Association of Real Estate Investment Trusts. So NAREIT is an industry association for REITs. And one of the things that NAREIT does, in addition to, publishing all this data about how great it is to own REITs, and I came across an article I downloaded the other day that said that even in rising interest rate environments, REIT values go up. And I only hold 3 REITs right now. I got 3 REITs. I got clobbered yesterday. 3 REITs, and they're not big positions. I lost $4,000 on 3 REITs yesterday because, you know, Treasury jumped. So, I don't know where they get their data. In my pocket, I feel it, okay? So, but, MSRED publishes, one of the things they do, they publish a tremendous amount of data. So they, on public, in fact, a lot of the reasons that many of the articles that you will be reading in this class use REITs is because REITs provide a view into real estate operations that private companies don't offer it. So academic research is much easier to do with publicly traded companies. But so you can go to REIT.com and also pull down like, you know, oodles of information like I did as well. What I did and even more. So I went asset class by asset class. I took a look at 1994 forward, okay, and blue is MSRED, publicly traded. The sort of burnt orange or whatever is MSRED, privately owned, and then I got the S&P, right? And it looks like it's all over the place, right? So they almost seem to sort of function independent of one another. Public and private real estate seem to function independent of one another. There's definitely what appears to be, at least in office, a higher return profile for publicly traded real estate, but definitely a heck of a lot more volatility. Look at that band. Look at that band, right? As opposed to, right? You see the channel? And so, just by looking at it, I'll show you the numbers later. I would venture to guess that, contrary to what I would think, that publicly traded real estate actually trades higher, at a higher return, provides a higher return. But that cost I talked about is probably in the way of greater volatility. Okay? And the other thing that becomes very interesting is once you get to 2000, it seems as if public real estate and the S&P sort of track one another. You see that? Why is that? They've always MSRED. Why? So before 2000, there didn't seem to be the same correlation between the S&P and publicly owned real estate. And starting 2000, that time frame, it seems to start mirroring it a lot more. So what happened is around that time frame, REITs started becoming part of indices, like the S&P, like the Wilshire. And so, and they started becoming a much more mainline investment vehicle. People that want to emulate certain indices, people that want to track certain indices. And what's happened over time, and you see it in office, but you see it in almost all of the asset classes, is as time has moved on, publicly owned real estate behaves much more like publicly owned real estate, I'm sorry, publicly owned shares like stock than it does like real estate. So there's a benefit to its liquidity, okay, but there seems to be some fallout as a result of it. And you can see the same thing with industrial. You look how they sort of mirror, right? The same sort of, wide bands. I'm not going to repeat it for all of them, but you can see that you start getting the same sort of. So for retail, same thing. Multifamily, same thing. Now, some things that you can, some other things that you can kind of take a look at, right? So they tend to mirror, right? They tend to mirror, but it looks like there's some sort of lags, right? Like it seems like stocks are running in advance of the actual real estate market at certain times, right? So maybe if you see the overall market going down, maybe you sell your multifamily REITs or something like that. Maybe that's a conclusion that one can draw from this.
Sure.
Same thing for hospitality.
Carol. The paper loss you had, right? It was a realized loss.
Well, we're talking about holding period returns here, right? And so holding period returns are what? Let's see who remembers what's holding period return. Somebody give me the formula for holding period return. very important we know this. Come on, we did this, come on. I don't have my notes with me, I want to try to do this off the top of my head. Ryan, you weren't here, do you know what holding period, you saw me on YouTube or not?
Yeah.
Do I have any views? Did I have any likes?
Six.
I had 6 views.
No likes, I'm sorry.
No likes?
No, not a single one.
No likes, but I had 6 views.
Sub in.
That was my mother, my father.
P1 minus
P1 minus P0
plus dividends.
over PO.
Okay, so price at the end of 1 less price at the beginning, right?
Correct.
Plus dividends, right? Divided by
Price of the beginning.
price at the beginning. So, Carol, to answer your question, whether it's paper or not, it may be part paper, it may be not. We're measuring from the beginning of a period, doesn't have to be a year. In this particular case, we're doing yearly returns, so it's from the beginning of the year to an end of the year. But really the assumption is that we're most likely holding on to this. So if you want to call it paper, then it may be paper. But there's no such thing as a paper loss. It's either, see that, going back to the psychology of investing, right? So, the word I couldn't remember before were technical factors, right? So, a lot of people follow technical factors in investing. So, technical factor are these crazy things like, why do the stock markets go up in January and then, you know, sort of traditionally go down? Why is there more volume at the beginning of a day and the end of a day than in the middle of a day? Why do stock markets historically go up on Monday, Tuesdays, and Wednesdays and go down Thursdays and Fridays? Because there's behavior that affects all this stuff. And there was an article the other day about saying that the individual investor gets clobbered because they place their orders at the beginning of a day. Because they wake up and they think they're going to make a lot of money. So individuals are the ones that tend to place their trades early in the day. And pricing at the beginning of the day isn't necessarily indicative of pricing at the end of the day. Okay, and so, so the reason I brought that up is, if I have stock that I bought for 1,000, if its value drops to 800, I don't have a paper loss. I got a real loss. I may not have realized it for tax purposes, but my value, the value of my investment is on. Now, psychologically, I haven't lost it. That's why people hold on to losses much longer than they should. Because when do people sell it? When it goes back up to 1,000. And that's why, look, I don't believe that technical analysis is voodoo. But intuitively, you buy a stock at 1,000. People talk about these support levels and all that, right? Support levels are points where people pile in to certain equities, right? So it's nothing. A bunch of people buy it when it's at 1,000. It goes down to 800. Ooh, nobody's selling. Ooh, I don't want. Ooh, it's only a paper loss. I haven't lost anything. Yes, you have, and I'm going to prove to you why in a second. Okay? And then, well, I'm just going to hold on. Get some time. Let me sell it. Let me sell it. I'm whole. I'm whole. Okay? I'm whole. Now, why do I know that decreases in stock values are real losses? So Chad asked me. Like I said, I didn't get a chance to read the paper because it hadn't been delivered when I left. And there's an article today regarding the CEO of a company called Valiant. We talked about Valiant the other day. So, as I understood the headline, I didn't read the article, and I understood the headline. Very simple. The guy had huge margin on his stock, so he borrowed tons of money against his stock holdings, right? And that's based on a certain percentage collateral. The value tanked. What did the bank say?
Bring you some money now.
Give me the money. Oh, you don't have money? They just liquidated the guy's holdings. So he wasn't going to do it because he believes the company, but it got taken out from him. And anytime, by the way, that's always a bad sign. When you see a CEO that's like on huge margin like that, and all of a sudden, like stay out of that stock. Stay out of that stock.
So you know what was D1 in that formula?
Dividend during the first year. You know, thought of in terms of real estate, privately owned real estate, what was the appraised value at the end of the year, less what was the appraised value at the beginning of the year, plus what cash flow did I distribute during the year, what NOI did I distribute, right? Right? Over what the original appraised value was. Yep. And this is an important formula to know for any of your investments. It doesn't contemplate the time value of money. That's why we then have to do IRRs, right? To try to figure out what the annual return of that investment really is. So, again, another reason too, why I don't distribute this, because this is voodoo. This is San Miguel voodoo here. It's indicative. It's not mathematically accurate, okay? Because I just don't have, you know, the bandwidth to do this. Because what I did was I extrapolated for all of REE by just using certain asset classes. There's a bunch of other asset classes, but I just extrapolated, okay? Believe it or not, this little chart takes like a week to put together because there's all kinds of math behind it, okay? Now, what did I come up with when I summarized it? I already showed you NCREIF returns, right? And sort of in aggregate, we were talking about a national return of about 9%, right? With a standard deviation of 8.5 and a 0.94 coefficient of variation. Well, publicly owned real estate seems to have a higher return, at least for these asset classes, okay? But look at the volatility, significantly more so. And you can start seeing that to some extent, it starts emulating, you know, the overall market. Now, my interpretation, this is 1994 to now. Why are these returns higher than the overall market? And that's because as real estate has become more in vogue, so people have been piling into those stocks, and they've increased the sort of valuation of the public valuation of that. Now, if you look at maybe a 40-year return 20 years from now, you most likely would not see publicly traded real estate outperforming the market. And probably from what the tendencies that I've seen in the last few years, not being radically off of the volatility as well. Okay? May not be mathematically accurate, but so, you know, takeaway, conclusions. Privately owned real estate, at least at an institutional level, seems to be a return enhancer and a risk reducer. And in the context of an institutionally owned real estate portfolio, or institutional portfolio, if you were to include real estate. Another takeaway could be that, at least during the period of observation, publicly owned real estate potentially has a higher return, but significantly greater risk component than privately owned real estate, okay? Even more so than the public market. Now, there's one other observation there.
Would you ever buy into hotels?
Well, no, that's like, I mean, that's voodoo, man. That's like, you know, and I did. If you take a look at mortgage REITs, mortgage REITs have a very similar. I mean, every time I've ever bought one, they're really totally wacky. Okay, so now I tried to mess around. I'm not even going to try to. I tried to do some stuff with those two slides here. So I know in my pocketbook, intuitively, I know that REITs are now performing more like interest-bearing instruments than even equities. So I started messing around with different, you know, spreads or data to see if in fact I could I could prove that, you know, and so I said, you know, what's the spread of what's the spread of equity REITs over treasuries? And I started messing around. I can't get any sort of information that makes any sense. But I know my pocketbook feels it. I know that, and I could tell you yesterday. But I also know that NAREIT has an article that says that in rising interest rate environments, REITs go up, and Quincy's going to tell us why next session, because we say that real estate is a hedge against inflation, and you know we can mark the market, our rents all the time, and all that stuff. Anyway, so well, I'm just going to bore you with one more presentation, and we'll take a little break, and then we're going to get to the meat of the. Okay, so this is another one that takes me a tremendous amount. I don't know if it's worth it or not. A tremendous amount of time, and so what I'm trying to get at here is how much, going back to the holding period return, how much of my return is current income and how much is capital appreciation? And again, I talked to, our investment style is going to determine that. So if we're living in a core world, we're going to have a totally different perspective on what we need in current income versus capital appreciation than here. Okay? And just jumping to, you want current income here, you don't expect capital appreciation, less volatility here, a lot of risk, no current income, right? Huge capital appreciations. Okay, we'll talk a little bit more. We'll talk about it, the last presentation of the day, we'll talk about styles of investing, okay? But my question is, in the context of publicly owned real estate, how much of my return historically has been current income and how much has been capital appreciation? So I use REE.com data for that, okay? And so I go through a whole process. We don't need to, you know, focus on every one of these because these particular charts are not overly telling. I just tried to decompose what percentage of the return was capital and how much was dividend every year. The sort of burnt line is what dividends are, okay? And then, you know, for mortgage REITs, what you could see is that there's a huge dividend component, right? But you look at the volatility with mortgage REITs, you know, 70% returns, 50% negative returns on your very highly leveraged vehicles and very, very sensitive to interest rate fluctuations. This is just a historical view on different dividend yields by asset class, and you can see that within the public arena. So the mortgage REITs, which are not equity, right, they're debt REITs, have significantly higher distribution ratios. And curiously, this bright one is a treasury. So if you're looking for current income and are not concerned with capital appreciation or the risk of capital loss, REITs tend to pay a higher current dividend than what the treasury is going to give you in a coupon. That's not a reason to invest in REITs. Okay, that's not a reason to invest in REITs. I'm not, and I'm in no way endorsing that. Okay. And what I ultimately come up with is that over this 20-year observation period, approximately 48% of the gains in REITs have been derived from capital gains and half from dividends. So in the context of publicly owned real estate, which is primarily core by nature, okay, lower leverage, Class A, major markets, right? Return is roughly, over this observation period, roughly half current income, half capital appreciation. Okay, so if it's an investor that's suitable for you, you know, to it. Why don't we take a little like 10-minute break? 10 minutes, 10, because we got it, so heavy duty stuff.
Program?
Yeah.